Good morning, ladies and gentlemen. Thank you very much for making it here so early this morning to join our International Finance Lecture. Let me tell you first that I'm very happy for being able to introduce Dr. M Mobius to you as our guest speaker this morning. Dr. Mobius is currently the executive chairman of the Templeton Asset Management. Well, he's going to give us a talk this morning on the current issues involved with emerging markets as well as new frontier markets. As you know very well, it has been a while since the world economy, and for that matter, the global financial markets began their recovery. The speed and scope of the recovery, however, have not been even among the countries. For instance, emerging markets have done a lot better and a lot faster than other markets and have attracted greater attention than others. But much remains unclear regarding, for example, the robustness and the sustainability of the ongoing recovery of the emerging markets. And also, much remains unclear as to the opportunities and prospects of the newly rising so-called frontier markets. So it is in these respects that we have high respect for Dr. Mobius' talk today. Well, I believe many of you are very familiar with Dr. Mobius' name because he has been a sort of pioneering figure in the business of emerging markets for so long. Well, he first joined the Templeton back in 1987 as president and portfolio manager of emerging market funds, introducing the first kind of such funds in Korea, in the market. And he, since then, he was with, still he is managing a vast amount of emerging market portfolios, directing the Templeton research team of 15, based in 15 global emerging markets. Well, in 2006, Asia Money magazine named him as one of the most successful emerging market investors. Well, he also has written a number of books, including Trading with China and The Investment Guide to Emerging Funds, and so on. Well, he earned his PhD in economics from MIT a long time back. And here, I think he is with us. And now, let me present him to you for his speech. Please give him a warm welcome.
I wrote that book, Trading with China, in 1970. And I made a projection of what trading China would do with the rest of the world, the trade, exports and imports with China. And at that time, I was heavily criticized for making too optimistic projection. As it turned out, I was about 200% under what China actually did. So you can be very, very surprised when you make projections. It can be way off, particularly in Asia with the kind of growth. And I can just remember when I was living in Korea in the 1960s. It was very, very different. I know many of you people here remember the tough times and the difficult times Korea had. I remember I loved to go to the Korean movies and cry because, you know, there was always a story about an orphan or somebody having a hard time or so forth and so forth. Now things have completely and dramatically changed. So I'm very, very optimistic of what we're going to see going forward. But let me give you a picture of the global situation. If we look at what's happening in the world today, there are two elephants. Recently I was in Africa. I was on Elephant Walk. And these elephants can be very, very nice and kind and gentle, but they can be also very fierce and dangerous. So there are two elephants in the investment room today that can be very good or can be very bad. One of them is money supply. Money supply has been going up at a very rapid rate. You can see here M2 in America has been moving up very rapidly. In the Eurozone, money supply has been moving up very rapidly. In Japan, of course, you all know the Japanese have been printing yen and putting them in the bank with no effect. And in China, of course, China has been printing at a very, very rapid rate. So we've seen a tremendous flood of money going into the financial markets around the world. And if you look at Asia, ex-Japan, loans to deposit ratios, you'll see that the banks are full of money because the loan to deposit ratio has gone down, not up. So there's lots of money looking for a home. And of course, that's been wonderful for all the equity markets around the world and bond markets, and particularly for emerging markets. The second elephant is derivatives. Again, derivatives have been very, very nice to markets because many of these derivatives are sold as if they are risk control instruments. So people get very confident. They can control their risks so they can put more money in the market. But they have become a huge gambling mechanism. And if you look at the size of derivatives contracts, it has not gone down, despite the fact that derivatives got us into this subprime mess. Derivatives contracts have increased. And the total value, as shown in this blue bar, is now over $600 trillion. That's 10 times more than the total world economic output. Far more than the total amount of bonds and equities around the world. This can be very, very dangerous. And we've already seen the danger. And by the way, whenever I visit a company, I'm constantly visiting companies around the world, I ask them, first question, what derivatives do you have? And if they tell me, oh, just plain vanilla, I get very suspicious. Because we've seen losses in derivatives at tremendous levels. CITIC Pacific in Hong Kong lost $2.4 billion. One company. Aracruz Cellulose, a very nice company in Brazil, lost $2 billion. KB Financial here in Korea, as you know, lost $1 billion, over $1 billion. Controladora Comercial Mexicana in Mexico went bankrupt with over $1 billion in losses. Harvard University, oh, I'm so glad it's not MIT, Harvard University, lost $1 billion. And Cemex in Mexico lost almost $1 billion. So this is a real big problem going forward. And we have to watch this because it's not over we were just discussing about regulation of derivatives, it won't happen because there's just too much money being made by investment banks with derivatives. What's the emerging market situation? It can be summarized in one word: growth. That's really why we are in emerging markets. And if you look at the growth, economic growth of emerging markets versus developed markets, you'll see that with the exception of 1997-98, when we had the Asian crisis, emerging markets have continued to outpace the developed markets. And this year we expect emerging markets to grow 4 times faster than the developed countries. 5.4% versus 1.7% for the developed markets. Big, big difference. And if you look at China and India, by the way, this is the most exciting thing that is happening to all of us. Why? Because you have 2 countries with over 1 billion people that are growing at 7, 8, 9, 10% in real terms. This is a wonderful thing for Korean manufacturers, for anybody in Korea selling goods around the world. And of course, if you go to India or China, you'll see LG, you'll see Samsung, you'll see all the Korean brand names. This is going to be a wonderful boon for Korea and for the United States and other countries around the world. You can see the U.S. is only growing at 3%, Japan at 2%. The other good thing that's happened since the Asian crisis, Asian countries learned their lesson and they began to save and build up foreign reserves. So we've seen since 2005, emerging market foreign reserves have far outpaced the developed countries. And if you look at China, now it's over $2.2 trillion. And of course, a lot of that is going to U.S. Treasuries, but some of it is going into emerging countries and frontier markets. I was just in Africa, in Botswana, in Kenya, in Ghana. And when I was in Ghana, I'd like to go to shopping centers, and I asked them to take me to a shopping center. And they said, which one, the Chinese one or the local one? I said, let's go to the Chinese one. There was a big shopping center, all Chinese companies selling Chinese consumer goods. Of course, on the way, we passed the big stadium that the Chinese have built and the roads that the Chinese are building and so forth. Very good effect for what's happening. Japan used to be the biggest. Now it's second. Russia is the third. $395 billion in reserves. Taiwan, India, Korea, Hong Kong, Brazil, over $200 billion each and so forth. And we've seen it, of course, in the appreciation of the currencies. Debt. Let's look at debt. Developed markets, debt is going up, not down. Emerging markets, the trend has been down. Now it's beginning to go up again because people are getting more confident about lending to emerging markets. But if you look at the debt to GDP levels, all those blue bars are developed countries. The red bars are emerging countries. Generally speaking, emerging countries have less debt. And by the way, this includes both public and private debt. Inflation and interest rates. Inflation has come down dramatically in emerging markets since July of 2008. Now it's beginning to creep up again, but it's still far below where it was. And of course, interest rates have also come down. That has had a great impact on markets, as you can probably guess, because people are not so happy about getting such low interest rates in the banks and are willing to go into equities. Now, what is the supply-demand situation? One of the effects of a higher equity market is, of course, more expensive equities, higher prices. That attracts more IPOs, more initial public offerings, because people see an opportunity to raise money cheaply. So we've seen, since January of 2009, as the emerging markets index went up, the number of IPOs and the value of IPOs went up with it. So we've seen a big new supply of equities coming into the market. Many people ask us, gee, how are you going to put all that money away? Because we now are running $38 billion in emerging markets. Isn't it difficult to invest? I said, no, it's not, because of this, IPOs. Many new IPOs coming into the market. So last year, a total of $87,000 million or $87 billion was raised in IPOs in emerging markets among 363 companies. This year, we expect it to be $238 billion among 359 companies. And as you know, in Hong Kong, amazing, unusual situation, Mr. Deripaska from Russia raised $2 billion for his company in Hong Kong. A very unusual situation for a Russian company to come to Hong Kong and raise that kind of money. So that gives you some idea of the flow of money that's coming in to these markets. But what is the demand? If we look at the emerging markets as a percent of the global market, just looking at the index, the MSCI index, by the way, the MSCI stands for Morgan Stanley Capital International. Actually, this index was started by Capital International, fund management company, one of our competitors, a very good company, been in the business for a long time, and it was bought by Morgan Stanley. But it is one of the standard indexes for various markets. But anyway, this blue line shows you emerging markets as a percent of the global MSCI index. And you can see it's fluctuated, but now it's gone up to 13%. In other words, according to MSCI, emerging markets represents 13%. But MSCI does not count all of the stocks in the world. If you count all of the emerging market stocks and all of the developed market stocks, it's more like 32% emerging markets representing of the world market capitalization. But if you look at the portfolios of pension funds in America and Europe, you'll find that they're in this band. 3 to 8% of their portfolio is in emerging markets. In other words, they're very underweight. And they're now beginning to wake up this reality. They're beginning to see and wake up to the reality of the growth that they're seeing in emerging markets, and they're now beginning to put money in. So we expect more and more money to go in. Of course, when things get tough, everybody runs for the hills, which what happened in 2008. You can see this is the flow of funds going into emerging market funds. In 2007, we had a great year. I had a big bonus because we had lots of money coming into our funds. Last year, I was in trouble because all the money was flowing out. And unfortunately, people get out at the worst time. They sell when the markets are down, and they buy when the markets are up. My sister-in-law is like that. In 1993, my sister-in-law bought our emerging markets fund at the top of the market. The next year, the market crashed. I had to go visit my brother, not my sister-in-law. I went to visit him. I knocked on the door. Who's there? She answered. I said, it's Mark. I'm not opening the door and give me my money back. I said, if you open the door, I'll tell you how to get your money back. She opened it up and left the chain on the door. I said, the best thing is to buy more. She slammed the door in my face. Of course, if she bought, she would have made good money. But you can see that now the markets have turned. We've seen a big flow into emerging market funds. And why? Why are people putting money in? Well, they're more confident. How can we measure confidence? We measure confidence by how much interest they're willing to take lending money to emerging markets. And this blue line is the spread or the difference between emerging market interest rates for sovereign bonds in US dollars and US treasuries. US treasury is supposed to be the most safe investment. And you can see that between 2005 and 2007, people got more confident. They were willing to take a lower interest rate. But then when subprime started coming in and all the crisis, that spread went all the way up to 8%. And what happened to the stock market? Stock market crashed. Now confidence is coming back, so the interest rate is coming down and the stock market's going up. So this is a very good measure of confidence. People are more confident now of emerging markets. And if you look at the very interesting thing, I was in Greece a few months back, and already they were beginning to talk about problems. And I was telling my Greek friends, don't worry, the Europeans are going to bail you out, which eventually will happen, I think. But we used to have Greece as an emerging market. It used to be an emerging market. But then they joined the European Union, and they said, no, we're no longer an emerging market. We're a developed country. Now they're back into the emerging market category, because if you look at the CDS, credit default swaps, by the way, it's derivative. This is the credit default swap is the insurance policy, as you know. And if you want an insurance policy against default by Greece, you have to pay more. You have to pay 350 basis points. Otherwise, you're not going to get insurance. And that's more than Russia. It's more than Brazil. It's more than China. Portugal is more than Russia. So you can see the change in attitude on the part of investors. Now, let me talk about the bull and bear periods, because I think it's important to look at this. This is the index on a log scale of emerging markets since 1988. We actually started our first fund in 1987. It's amazing. At that time, in 1987, we raised for this first fund $100 million. And I had real difficulty investing because we had only 5 markets in which to invest. Mexico and 4 countries in Asia: Hong Kong, Singapore, Philippines, and Malaysia. All other countries were closed. Korea was closed. We couldn't invest here for foreign investment. Foreign exchange controls, so forth and so on. Now we have $38 billion, and we have no problem because we have over 50 countries around the world where we can invest. So things have really changed in that respect. But you can see that during this whole period, there were 3 major bear markets, as indicated by these yellow bars. The Asian financial crisis, market went down by over 50% in 1997-98. Then after that, we had the tech bubble. Remember the internet bubble? That was really a bubble. And I got into big trouble that time because everybody was crazy about tech stocks. Remember, one of the indicators was not yield, dividend yield, not price earnings, not balance sheet strength, but burn ratio. You remember that? Anybody remember the burn ratio? The burn ratio was how fast money was being spent by the company. So if a company raised money, it was penalized if you didn't spend it fast enough. You didn't burn the money, acquiring other companies and so forth. And I was in Paris talking to a group of journalists about emerging markets. I wasn't talking about the tech. But one of the journalists said, what do you think about this tech situation? I said, there's going to be a big crash. And it was more or less at the top of the market at that time. I'm no big predictor. I cannot predict. But it just hit the markets at the right time, and the market the next day went down by 5%. Because it went on the wire, the Reuters wire. I got a call from my boss. Could you keep your big mouth shut? All the brokers are blaming me for the fall in the market. Because, a lot of the brokers are selling our funds, so they didn't like to see the markets going down. But this is the kind of situation we had at that time. Market was down by over 48%. And now we have the subprime crisis where we had 65% decline. So things have become much more volatile. But if you look at this, the white areas of this chart are much bigger than the yellow areas, which means that bull markets last longer than bear markets. And if you summarize this, you'll see that on the average, the bull markets during those that period since 1987, 88, went up by an average of 423% and lasted on the average of 69 months, while the bear markets went down by an average of 57% and averaged 14 months in length. And the reason why I find this chart very important for me, because our founder, Sir John Templeton, and I and a few other executives were at a meeting in Canada. In those days, we had these big meetings where, hundreds of people would come and we'd talk and get questions from the audience. And during the question and answers period, a young lady got up and she said, Sir John, I've just inherited some money, and I'd like to know when is the best time to invest. Sir John said, young lady, the best time to invest is when you have money. And I thought to myself, what a strange thing to say. And I realized what he was saying. This, you're better being in than being out, because the bull markets last longer than the bear markets. And if you're strong enough, the best thing is to buy more when the bear market comes, because it's going to be very short in duration. And we've just seen that. I mean, in November, December, January, February of last year, I was urging people, get in, get in. I was, of course, putting money into my own funds at that time. Now we're up 70, 80, 90%, in some cases 100%. So it's very short-lived. And we're going to, of course, have more bear markets as we go forward, but the lesson is very, very clear. Thank you very much for your attention, and I'd be happy to take any questions you may have. Thank you.
Thank you very much for your excellent presentation, Dr. Mobius. I recall that I met you about 2 decades ago. I was field research and also portfolio securities when the Korean fund and the Korean Euro fund is launched.
Oh, yes.
You are so energetic and challenging and very not changing at all. Congratulations on that point.
Thank you.
Long time the expert. Why that emerging market like Vietnam fund? Vietnam is not recovering. It's Korean trust company advocate that Vietnam will be second to China. So a lot of Korean investors invest in Vietnam fund. But China fund, like media said, Solomon fund and Discovery fund recovered about 20 to 25 minus range. But the Vietnam fund is only stayed 40% down, about 50% down, still not recovering at all. What would be the reason for that?
Korean investors have been very daring, I must say, and going into Vietnam and frontier markets. And I think fundamentally it's a wise decision. It will turn out okay. The problem with Vietnam is this. First of all, the regulatory system in Korea is very bad for investors, for foreign investors. Because when we buy something in Vietnam, we must first inform the stock exchange what we intend to buy 3 days in advance. What we intend to buy and how much. So you can imagine what the Vietnamese investors are going to do. They're going to front run us. They're going to buy ahead of us. The second rule is that we must only use one broker. So if you're only required to use one broker, you're stuck. Your broker is going to front run you. He knows what you're going to buy. He will buy in advance of you, and you're going to have to pay up. The other problem in Vietnam is the liquidity is very poor. The turnover is very poor. So you must have sympathy for the gentlemen who are running these Vietnam funds. Nevertheless, the prices in Vietnam are very, very low. It's one of the cheapest markets in the world. The price-earnings ratios, it's just amazing. In fact, we have a long investment in Vietnam. We actually went into a joint venture with the Vietnamese army in an apartment building in Hanoi. And after 10 years, we're finally getting our money back. It's working out okay. We're not making a lot of money, but we also have a joint venture with Vietcom Bank and an office there, and we're finding lots of bargains in Vietnam. So my inclination would be to say that it's better to be patient. Look at the average valuation of the portfolios. If you have a portfolio manager who's not going to turn over a lot. In other words, it's not a market where you want to trade in and out because, you're going to get killed each time you go in and out. But if you buy and hold, and if the stocks are good, I think you should do very well. We just, in fact, I was there last week and we visited Vina Milk, which is the largest stock there. They sell milk and all kinds of dairy products. And the company is fantastic. It's very well run. It's run by a woman, by the way. Of course, partly, it's controlled by the government, but it's listed. Really first-class operations. And we visited another company, a few companies there, and generally speaking, the managements are quite good, and the valuations are low. So those of you who have Vietnam funds, again, it might be an opportunity if you can buy it at a big discount, or if prices are down, might be a good idea to buy more. Because provided that portfolio, you have to look at the portfolio and see if the good stocks are there. But it's something I'm interested, by the way, if you can get me some stock in the Vietnam fund. Yes, thank you.
Okay. Your excellent presentation, and especially your optimistic view. I understand that you have been in the Asian market 40, 50 years, and also covering Korea. And a long time ago, myself, I was a foreign banker myself. So I want to compare maybe 15, 20-year time perspective. When I was a foreign banker, when I was want to increase Korea country ceiling or raise larger money through syndication of loans, then I have to sell Korea country risk, and why Korea is safe, etc., etc. But watching what's happening these days, especially after this sinking of naval vessels, nothing happens. Say the Moody's is raising Korea country rating, and also watching the Korean CDS, top credits of Korean corporations still enjoy CDS rate of below 60 basis points, and foreign investments in Korean stock market still coming in. Even yesterday alone, almost $300 million was coming in. So of course there are big difference between in Korea between 20 years back and today. Size of economy is different and fundamentals of economy is different. But I would like to know what's the difference, what happened to the perception of lenders, foreign lenders and investors about Korea. Thank you.
Foreign bond investors, foreign equity investors do look at the fundamentals. They look at the economic growth, they look at the debt ratios, they look at the credit ratings of the countries, And as you noted, the fundamentals of the Korean economy have done very well. The other thing that's happened is that Korean companies have changed dramatically. 20 years ago, nobody would have bought a Hyundai car. Now, Hyundai and other Korean manufacturers are leading in many countries around the world. You see the brand names of Korean companies, Samsung, LG, all over the world. So the confidence in these companies is increasing as a result of this global presence that they have, and of course the growth that they've exhibited in many areas. I think the other aspect is the technological preeminence of many of the Korean companies. Now you have Samsung being the leading memory producer in the world. You have, in fact, I was in Busan last week visiting some companies that are doing components for pipelines and various equipment that is quite unique, that you can't find in more than 2 or 3 companies around the world. So I think all of this is adding up to higher confidence on the part of investors. And so they ignore North Korea. Of course, North Korea is in the back of their minds, but then with China there as a moderating influence, and with the growing trade between Korea and China, they begin to feel, well, you know, okay, there may be a few incidents, but at the long run, nothing's really going to happen. So I think that's really what's caused it. But I think you have heard about the Korean discount, because Korean companies have tended to be cheaper in valuations than other companies around the world, equal companies. And this discount, I believe, is because of the low level of dividends paid by Korean companies. The orientation of Korean companies is very Confucian in their outlook, in the sense that they are looking at generations. They're looking from a family point of view, looking at not this generation, but the next generation and their generation after that. So they continue to invest and expand rather than returning money to investors. And I believe that causes the discount that you've seen in some of these companies. I believe that's going to change going forward. I think in discussing this with many Korean companies, they're beginning to realize that they've got to think about the shareholders, and if they can get a much higher return on investments than an investor can get in a bond or a savings deposit, fine, you know, invest that money. But in many cases, we've seen Korean companies invest where the returns are very, very low. So that's something that we have to look at going forward.
I have 3 short questions. First one, you said a bull market tends to last longer than bear market. Have you kind of observed empirical regularity? Can you say, bull market tends to last perhaps 2 times longer than the bear market, or 1.5 or 3 times? So if you have that kind of figure, please tell us. The second question, your euphemism of 2 elephants was great. They're nice and kind, but they get to be fearful and very dangerous. About the derivative markets, do you think the derivative markets would like to die out, or going to flourish again as the market turns to the bear market? If that is so, when? Is it going to take a few years before the derivative markets get back to a normal stage, or etc.? And the third question, you talked about the Greece case. Once it graduated from emerging economy and then to the developed market, after it joined the euro, EU. So what about the Korea? Is Korea graduating from an emerging economy or already graduated from, or what? I'd like to hear your opinion. Thank you.
Just a general guess, and of course you have to look at different markets around the world. Bull markets last 4 or 5 times longer. That's a general rule from what we've seen, but it's not regular, and there's no way of predicting. If you look at that chart I showed you, you can see that we had 2 bear markets pretty much close together within a 5-year period. And then there was a longer period when we had this recent crisis. So the challenge to us is trying to be able to understand when we are going to get a bear market, and it's very, very difficult. In fact, I would say it's impossible, because as George Soros has pointed out, there's a feedback mechanism, reflexivity, that takes place. So if you think there's going to be a bear market and you behave that way, there's going to be a bear market. You're causing it because you're selling. So it's very interesting to look at cycle theory. As you know, the great Russian Kondratyev talked about cycles, 40-year cycles, and there are all kinds of cycle theories that we have to look at. But fundamentally, I would say it's not a very good guide to investing. We haven't been able to do it. As regards to derivatives, the derivatives market, despite the fact that we had this subprime crisis, is not dead. It's alive and well. I'm sure all of you who have bank accounts have been approached by your banker to buy some derivative instruments. You may not know it's a derivative, but it is. So when they come to you and say, hey, you've got Korean won, I can give you a US dollar interest rate that's higher, and I can protect you by keeping it in won. He's selling you a derivative, basically. In Hong Kong, they were selling a very interesting instrument to people. They said, look, if the stock is $20, we will sell it to you for 15. Sounds good, right? But you must continue to buy even if it goes down. And as the price goes down, you must buy more. If the price goes up over 20% from where you started, you have to stop. You cannot make any more money. That's a derivative. And of course, they call it accumulator. And in Hong Kong, accumulators began to be known as I kill you later. So derivatives are alive and well. And as I pointed out to you, it's over $600 trillion. Now, why do I think that it's very unlikely to be killed? Because there's so much money being made. Why would you want to kill the golden goose that lays the golden egg? Bankers around the world, investment bankers, are making tremendous amounts of money on derivatives. You can go to any Korean company and you can ask them, have you been approached to buy a currency hedge or interest rate hedge or something like that? These are all derivatives. Some of them are quite innocent and very useful. You must remember the derivatives had a use for farmers where they started. You know, the farmers in America had to know what price they would get for their wheat, so they would sell forward. And of course, there would be people who would buy those options. And it was a very useful thing. But now it's become a huge thing and complex thing. It's essentially a gambling mechanism. It's a big gambling business now. I have nothing against gambling. I love gambling stocks, by the way. They're very, very profitable. So, now regarding emerging markets and Korea, I don't know why the Koreans don't want to be an emerging market anymore, because emerging markets are the exciting things. But anyway, Koreans tend to think they don't want to be considered emerging markets anymore. And I think there's justification, because the rule that we started out in 1987 was to take all of the low and middle income countries in the world and classify those as emerging markets. And low and middle income meant per capita income of, I believe it was less than $10,000. Currently, the average per capita income in the developed countries, US, Japan, etc., is $40,000 a year. Correct me if I'm wrong, Professor, but in Korea it's 20,000, is it?
Yes, around.
About 20,000?
Yes.
In emerging markets, Russia's the highest is 1,000. So Korea is right in the middle. They're between the developed and of course the rate Korea is growing, you're going to reach 40,000 very soon. So from that point of view, Korea would be considered, on the developed category. But I like to use growth rates as a measure of emerging markets. From that point of view, I think Korea is going to grow at 5% this year or more. It's definitely in the emerging market category because of the rapid growth rate. So that's where we are on that. Thank you.
Okay.
Which have always been considered the secondary place to be. But I'd like to turn that table around a little bit, because it seems that there are a lot of good arguments that say developed markets have now compromised themselves so badly, particularly with their financial sectors, particularly, if you like, the sort of global leader in finance of London, and the significant, of course, financial player of the US. That compromise has impacted the world with a crisis over the last couple of years, and we've fortunately all been able to survive it. But the after effects have hardly even begun to show yet. There are a lot of consequences yet to come out. And some argue, as Dr. Michael Spencer of Deutsche Bank did the other day with the Seoul Financial Forum, that with the various forms of extra taxation, increased regulation, and so forth, that are likely to be imposed on banks in the US and the UK and perhaps in developed country banks, they are going to continue to be further compromised. They will function less effectively as recyclers of global savings, which largely come from this region and what we might call the emerging markets group. It would seem to me that so-called developed markets are likely to be on the wane in the future, and emerging markets, as you've already demonstrated, are at least in the short term showing dynamics, but arguably in the longer term, if they take advantage of this weakness and compromising of regulations and business positions that's happening in the West, have even more opportunity to stand out, of which Korea would, I think, much rather be in the emerging group rather than the developed group. And it seems to me the distinction which countries are going to be hurt by that and which are going to be benefited by that depends a lot on those who let their traditional banks become gambling casinos, as opposed to those who kept their traditional banks in the classic game of raising customer deposits and lending them out in relatively straightforward and simple ways. Do you have a viewpoint, first of all, on what's likely to emerge, what's likely to happen in these developed country financial structures, and secondly, how that may affect the attractiveness of the emerging markets that have always been the sort of orphan child, but actually, partly because of China, are now likely to become much more and more the main game?
Towards emerging markets, the BRICS, so-called BRICS, Brazil, China, Russia, India. So there's definitely a growing confidence, as I've pointed out. In the developed countries, I think what is happening and what is hurting them and will hurt them going forward is the higher taxes. The higher taxation regimes in the US and, of course, already in place in Europe will continue to tend to depress growth in these markets. And unfortunately, unemployment. because it's really interesting the way the administration, the U.S., has turned around their views, because Larry Summers in the past used to say that, lower taxes were better because it stimulated employment. Now he's saying higher taxes is good for unemployment. So there's been a sea change in thinking in Washington regarding growth and unemployment and all of these things. But I think we have to be very careful as investors to differentiate companies globally, because there are many American companies, many European companies that are going to be very, very profitable going forward because of their global presence. There are many companies in America that have a very big footprint in emerging markets and are very well run, and they will do quite well going forward. So I wouldn't abandon these markets completely, if you know what I mean, because there will be opportunities. By the way, I don't want to blow our own horn, but Franklin Resources, our parent company, now has over 1,000 people in India working. In other words, India has become Hyderabad, where we have a back office operation, has become our single biggest office in terms of number of people. Now, it's not just doing back office. We're beginning to sell our funds in emerging markets. We have 2 or 3 billion in China, 2 or 3 billion in India. Of course, a small percent, but it's growing very rapidly. So it's companies like this. And in fact, I'm very proud to say that Franklin Resources is a bet. This may sound unbelievable. I checked the numbers. Has performed over the last 30 years far better than Berkshire Hathaway. Berkshire Hathaway, as you know, is Warren Buffett's company. And, if you look at the chart, Franklin Resources is up here, and Berkshire Hathaway is down here. And, of course, Berkshire Hathaway has done very well. So there are lots of companies like that in the developed countries that will continue to do well because of their global footprint. And it's something to look at going forward. But the problem now facing the U.S. and Europe is how to do something about the regulatory framework. The problem, it's interesting, I don't know whether you've ever heard of, you know of Ayn Rand. Any of you gentlemen should pick up a book by Ayn Rand, A-Y-N, Rand, R-A-N-D. She was a Russian immigrant to America who hated the communists and who believed that everything should be free. There should be a completely free economy with no government regulation. And she wrote a number of wonderful fiction books. One of them was called Atlas Shrugged. And I can't remember the other one, but they were made into films, if you ever have a chance. But basically, she was very influential. And she influenced the Federal Reserve chairman. So he became a staunch advocate of completely free markets, which is why the Federal Reserve refused to regulate the markets even after long-term capital management disaster took place, if you remember. And that philosophy permeated the American philosophy in government for a long time. Recently, it's very significant, before a congressional inquiry, he said, I was wrong. My philosophy was wrong. We should have regulated. And I'm sorry that we made this mistake. Unfortunately, other members of the administration are not willing to admit their mistakes, but he was brave enough to do so. And Greenspan, I think you've got to congratulate him for doing so. But the warnings were there, and there has to be a change in philosophy. There was a woman who was heading the Futures Commission, Mrs. Bourne, Bursley Bourne, and she was warning them back then even before long-term capital management, said, look, you've got to do something about derivatives. We should regulate derivatives. But Larry Summers, Rubin, and all these people said, no, we should not regulate. Now they realize what happened, and she was right. So the debate is on, but as I said, the forces against regulation of derivatives are very, very strong, and I personally don't think that the regulations will be put in place.
It was written in Korean. Well, you seem to express that pretty positive view on BRICS. And this year, if you know any emerging markets or frontier markets, which has most promising future, and you probably can name them. You may be call order, but you name these emerging markets in terms of the promising order, and frontier markets too.
Yes.
Okay?
Yeah.
Can you do that? It may take time, but you can try.
Oh, you mean which countries, which markets?
Which market, which countries?
Which countries?
In the order of promising.
They're all good. See, the problem we have with doing that is that we are so-called bottom-up investors, ground-up investors. We look at companies first, not at countries, not at sectors. So if you look at I guess the best way to understand which countries we favor would be to look at our portfolios. What are the weightings in our portfolios? And the biggest countries begin with Brazil. Second is India. Third is China, which may surprise some of you because China is faster growing than the others, but we're finding better, cheaper companies. Thailand, which again may surprise you, but we think Thailand is very, very cheap. Turkey and Russia. If you look at frontier markets, the ones that we favor the most now are Vietnam, Ukraine, Kazakhstan, and Nigeria. I would say in that order.
What do you think Korea belongs to among the emerging markets?
Among emerging markets, I would say they're in the middle. Not the lowest, but I would say more or less in the middle. Maybe 10, 11, like that.
Well, which company do you like most among Korean firms?
Oh.
And the reason why? And what is your judgment on Korea's market performance this year?
Predictions I never make. If again, you have to look at our portfolio, and it's not necessarily because we favor a particular company, but what we do is we have a system where we do a very intensive 5-year analysis of a company's financial records. We then visit the company, ask questions, then we make a 5-year projection of what we think the company is going to do in the next 5 years. And then we decide on what price we should use to buy that company. And whether we get the company or not depends on what happens in the market. So we may like a company very much, but we can't get it because the price went up too high. But if you look at our portfolios, you'll see that Samsung Electronics is the largest because it's the most liquid, easier to buy, and happened to be cheap when we were buying it. So that is the largest single company in our portfolios. It's not necessarily the favorite because we're trying to buy others, but I'm not going to tell you what we're trying to buy. And what was the next part of your question?
Your judgment on Korean market prospects?
Prospects.
Your assessment.
Well, yeah, my assessment, as I mentioned, I think there's a gradual changing in attitude among Korean companies. I think the dividends will begin to creep up, and that will be a very positive development for Korean companies. So we're particularly interested in Korean companies that are moving into frontier and emerging markets, because I think the Korean companies are very capable of operating in difficult environments like India. I was talking to the POSCO people recently, and they have a very difficult situation in India with their project, but they're not going to give up. They will eventually succeed in doing it. So the Koreans are very adept and tough and willing to wait and patient, willing to take a long view, and that's what's needed in many of these markets. And of course, when they do that, it will be very profitable over the longer term. So we're focused on companies like that, which have this willingness, ability, and desire to go abroad into other emerging markets and hopefully frontier markets.
Satisfied with
Bloomberg always asks these questions because they wanted help. And they're recording me right now, so they will be broadcast on Bloomberg. So you better all go out and buy Samsung electronics now, because it's going to go up.
Okay.
I really enjoyed your presentation. Thank you. I learned a lot. First, I have some extra fund to invest. Maybe I may go to bank. What this have done. At the year, you're really optimistic assessment on the Korea and China. And I give you two choices: either go China or Korean funds. Which way I should go? I should go everything China or go to Korean fund or divide? Okay, please tell me. And the second question, I think you mentioned about direct regulation of the derivative market and so on. And UK Prime Minister Gordon Brown commented yesterday after seeing the Goldman Sachs scandal, really painted as the moral bankruptcy. At the forthcoming G20 conference, I think the leaders is going to discuss about the new financial architecture. My question is that you also mentioned that the regulation of the derivative market, but your view is different. Some Korean scholars, people saying that we better build up some financial stability board. In this regard, what is your view? Which way Korea should go? Sitting on the side of the UK and the US position, or this emerging market view and setting on like financial stability board rather than direct regulation?
Yeah, to answer the first question, Korea versus China, neither. You should go into a diversified emerging markets fund, global. One of the things we learned very early on is that no one market is going to be the best performing year after year. In the last 20, 30 years, there's only been one market, I think, Hong Kong, that was the best performing in 2 years, but not 2 years in a row. So you must be globally diversified. The best way to do it is by getting a diversified emerging markets fund or a global fund. I wouldn't, unless you're already doing that, then maybe you can pick countries, Korea, China, very difficult. I would say probably China over the longer term, but I think you should be diversified. The second thing about the regulatory system, my feeling is that our whole financial structure is all screwed up. In order to have a proper financial structure, you have to think of incentives. People must be paid. You must follow the money. Let me go down the list. Let's start with the accountants and the auditors. Who selects the accountants and the auditors? the management. Who are they going to do favors for? The management. So the accounts already are favoring the management, are hiding a lot of information from the investor. So you must change that incentive. Accountants must be paid by the investor. Credit agencies, Standard & Poor's, Moody, why did they rate these credit default swaps and credit default options AAA, AA? Because they were being paid by Goldman Sachs and by the people who are asking the ratings. Why should they give an E rating or D rating? They're not getting paid to do that. Let's look at the regulators. Who selects the regulators? The politicians. How do the politicians get elected? They're paid by the bankers, by people who have money. And therefore they want to select regulators who will not regulate, who will not restrict. And you have to go down the list of each one of these players. And it's not to say that they're wrong or they're evil or they're bad and so forth and so on. But it's in other words, you need to have a structure which will incentivize the people in each part of the structure to do the job that the people think they're doing, which they must be doing. So unless we begin to look at that, it will be very, very difficult. We'll have a cycle, continuous cycle of this fraud and problems. I'm reading I love economic history because history repeats itself. And I'm reading a book about Ivar Kruger, who was the match king in the 1920s. He was a Swedish man who had the Swedish match monopoly in Sweden. In those days, you used these stick matches, and it was called safety match because the German match blew up in your face because it had the phosphorus in the tip of the matchstick, and they devised a way of getting the phosphorus on the box. So when you struck the match and the phosphorus was on the box, it wouldn't blow up. It would light. Anyway, this gentleman went to America and started like a Ponzi scheme and raised money from America. And the same things that we're seeing now happened back then. He had derivatives. He didn't give. He bribed the accountants to fix the accounts. At that time, his accountant was Ernst and Ernst. You heard of Ernst and Young? It was Ernst and Ernst in those days, the Ernst brothers. And one of the Ernst and Ernst accountants was wined and dined by this very nice gentleman who brought him to Europe and so forth, and he fixed the accounts without knowing it. I mean, thought he was doing the right thing, but so these things repeat themselves. You're not. It's not like something new. So I'm not too optimistic about. So as investors, we have to be very cautious. Don't trust the regulators to protect you. Don't trust anyone because you've got to look after yourself. Don't even trust the fund manager. Don't even trust me. That's my sister-in-law talking.
One last question as you're ending on the subjects of financial architecture. Glass-Steagall Act allowed the combination of what I'll call traditional banks, deposit-taking institutions, with what you'll simplify as investment banks, risk-taking institutions. Today, it's fair to say, I think, that is at the root cause of a lot of the destruction in the UK and US financial system, and a big part of the cause of governments having to bail out too big to fail companies. What, in your view, is the prospect for returning to a kind of Glass-Steagall separation of deposit-taking institutions and risk-taking institutions?
I would love to see Glass-Steagall come back, but I'm afraid the cat is already out of the bag. It's very, very difficult because of that 600 trillion there. It'd be I would say it's impossible. What's the gentleman named, the advisor who's recommended the rule to separate former Fed chief? Volcker. Volcker rule would be great, but he's been ignored because the people don't want to see that.
Well, if we view that as the irreversible, unfortunate status, let's say in America, but if you're Korea, you still have the opportunity to avoid getting into that trap because Korean banks, by and large, are still more pure deposit-taking institutions. It seems to me that they therefore have an inherent advantage over their Western or U.S. counterparts.
Yeah, that's a very good point. I think the Korean banks, being closely regulated, and hopefully that will continue, can avoid these risks. But unfortunately, you see, what will happen is that as this machine, continues, many banks around the world will look like they're making a lot of money because of these derivatives transactions. So it'll become very tempting to make comparisons and say, oh, well, why aren't you doing what those guys are doing? Well, why are your banks earning so low and so forth and so on? So the temptation will be there. I think the immediate solution would be to impose a tax on derivatives, some kind of turnover tax, and force, as a result of a tax on derivatives, force these derivatives out into the open. In other words, force them to be transparent and liquid. In other words, have them listed on markets. That would be a big step in the right direction because at least then you could have a market price. Because that's one of the problems we faced, that there was no price. The price was being fixed by the issuer, not by the market. So if we impose a small tax, maybe 25 basis points, 10 basis points, imagine 10 basis points on $600 trillion would raise a lot of money for governments around the world. But that would force derivatives out into the open because you would have to have a market. You'd have to have them transparent. So that would be one answer, but I don't know whether that would be adopted.
Okay, I think we have to wrap it up at this moment. And I think we have had a very wonderful and very interesting talk today, and very frank exchange of views, of course. And it's interesting to learn that there are good derivatives and bad derivatives, but we cannot avoid the bad derivatives. As long as the people have some gambling instinct. So we have to contain this gambling instinct in the first place. So it's very interesting things to discuss today, and I hope we can have another occasion to have you in the future. And thank you very much for being with us today.
Thank you. Thank you very much.